In this video, I want to cover a very accurate indicator that tells you exactly when to enter and exit your positions. To add this amazing indicator to our chart, here we click on indicators and we search Klinger oscillator, this one, which is an editor's picks indicator and written by someone named Classic Scott. Alright, this is the indicator, and as you can see, it's added here below the chart in the form of an oscillator where these two lines are oscillating above and below the center line, which is set at 0. This indicator was developed by Stephen J. Klingers, who is a famous trader and author in technical analysis. This indicator is built based on two exponential moving averages, and volume also plays a role in this indicator for confirmation of the price movement. This line that changes color between blue and orange is Klinger oscillator, and this line is our signal line, which is actually the moving average of the oscillator line. If we go to the settings of the indicator, you can see that for Klinger oscillator, by default, we have two exponential moving averages at 34 and 55. And here for the signal line, the look back period is set at 13. And here we have a complete list of different types of moving averages that you can choose, depending on your trading strategy and other indicators that are used in your trading strategy. You may need to choose a specific type of moving average, which you can select your desired one from this list. We continue with exponential moving average, which is a good choice for our trading strategies in this video. Before I teach you how you can use this indicator for trading, please give this video a like, and if you haven't subscribed yet, please subscribe and hit the bell so you get the notifications of my new videos. Alright, as I said, this line is Klinger oscillator line, and you can see that it's moving above and below the center line, which is 0. Just similar to any other oscillators, when the oscillator is above the center line, the market is advancing in an uptrend, and when it goes below the center line, the market is declining in a downtrend. In case if you want to use this indicator for trend identification and see the overall trend of the market, you need to adjust the settings for the two exponential moving averages here, because by default they are set at 34 and 55, and because of this you can see lots of noises around the center line. But if you increase the length of the moving averages, the oscillator line becomes smoother and better, showing the trends of the market. For example, if for the shorter moving average we set it at 100 and for the longer moving average we set it at 200, you can see that now the oscillator line is better, showing the trends without having center line crossovers in the pullbacks. I don't recommend using center line crossovers as buy sell signals, because during flat market, like for example here in this part, we can still have lots of false signals, and better to focus on trend identification of this line, and then by the help of another indicator look for buy sell signals in the pullbacks. For example, when the oscillator line is above the center line, we look for buying opportunities in the pullbacks, and when the oscillator line goes below the center line, we look for short selling opportunities in the pullbacks. Let me go to the settings of the indicator and reset the settings to default settings and explain other use cases of this indicator. As I said earlier, this line is signal line, and the crossovers between signal line and the oscillator line shows short-term momentum changes that are happening in the market. When the oscillator line crosses above the signal line, it shows increased upside momentum, and it's actually a buy signal, and when the oscillator line crosses below the signal line, it shows increased downside momentum, and it's actually a sell signal. But as you know, not every increased momentum can provide enough movement of the price worth of trading, and in the pullbacks we can have these crossover signals, as you can see. So we need to somehow filter the false signals, and the best way is taking the signals in the same direction with the current trend of the market. To show you an example, here we click on indicators and we search CCI, this one, commodity channel index, and we need to change its settings. So here we go to the settings of CCI, and here for the length we set it at 100. With this setting, CCI will help us with longer term trend of the market. When CCI line is above the center line, the market is trending up, and when CCI line goes below the center line, the market is trending down. In downtrends we only focus on sell signals, and in uptrends we only focus on buy signals. For example, here, since CCI CCI is above the center line, we only focus on buy signals. This indicator also shows these blue and orange dots when there is a crossover of oscillator line and signal line. The blue dots are sell signal and the orange dots are buy signal. To decrease your risk, you can take the signal only if CCI is also above its moving average line. For example, this buy signal here is confirmed because CCI line is above center line and also above its moving average line. But for example, these buy signals are rejected because you can see that although CCI line is above the center line, but for these signals, CCI line is below its moving average line, which shows weakening of the uptrend, and you can see that they were all bad signals, not worth of trading. To decrease your risk even more, you can also reject the signals if CCI line is above 100, so you will not get caught in overbought condition of the market. This was just an example to show you how you can take these signals in practice in a way that you only take the ones that have higher probability of giving the expected result. Another use case of this indicator is divergence. Klinger oscillator is also a great tool for spotting divergences. For example, here you can see that the price made higher high, but the oscillator made lower high. This is a bearish divergence. It tells us that the upside momentum is weakening, and on the other hand, the downside momentum is gaining strength, and this gives the possibility of reversal. But divergences can also happen in the pullbacks, so we need more confirmation that the uptrend is really ending and a downtrend is probably forming. One effective way is using price action analysis. Here we mark the high of the divergence pattern and we wait for a candle to be closed below this level, and when this happens, this shows that the structure of the uptrend is already violated and probably a downtrend is forming on the chart. And similarly, for a bullish divergence, we mark the high of the divergence pattern and we wait for a candle to be closed above that level. This indicator is a very powerful oscillator that can be used in any type of trading strategy, and it can be effectively used with other TradingView indicators buy-sell signals to find the most accurate buy-sell signals in the market. The important point is that this indicator, this setup, or any other trading strategy will never give you 100% guaranteed signals. Losing positions are always part of the game and you need to manage your risk properly. There is a risk management strategy that is called 1% rule, and it's one of the best risk management strategies that you can use. I have a complete guide on this. The link is also placed in the description and I highly recommend you to watch it, because without a proper risk management strategy, you cannot become a successful trader. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video and good luck with your trading.